Hey everyone, welcome back to the Dividend Drip. If you're tired of relying solely on your 9 to 5, or you want to build your wealth for the long term, then dividend investing might just be the thing for you. Today, I'll break down everything you need to know about dividend investing, from what it is, how it works, and how you can start building passive income using dividends. So let's dive in and start from the very beginning. What is a dividend? So, what exactly is a dividend? At their core, dividends are what companies pay to their shareholders out of the profits they've made. It's like a reward for owning a piece of the company. Let's use an example, just so you can have a better understanding of how this works. In this example, we're going to use Coca-Cola. Now, these are not the actual prices of Coca-Cola, it's just an example so you can have a better understanding of how it works. So let's say you own one share of Coca-Cola, which is $100 per share. The dividend that Coca-Cola pays out for each share is $4 per share. These are usually paid in quarters, but it's also calculated annually. So for one share of Coca-Cola at $100 per share, paying a dividend of $4 per share, that would mean you make $4 per year, which will give you a 4% dividend yield. Now, look, let's be real. $4 per year is not a lot of money. You can't buy anything in this day and age for $4 per year. It's just not worth it. But let's take this a step further. Let's say the year is 2004 and you want to invest $1,000 into Coca-Cola stock. As you just purchased $1,000 worth of shares, giving you the 10 shares, this will mean that you receive $40 per year in dividends. That's essentially $40 per year for free. They're giving it to you as a thank you for owning that stock. And on top of that, you'll receive the growth from the stock price increase over the years. One thing to be aware of, earlier on I mentioned that $4 per share is what you get paid per year from the Coca-Cola stock. This will give you a dividend yield of 4%. So $4 out of $100 per share will be 4%. But for now, let's move on to the second part. Why dividends matter. Now, why are dividends such a big deal? For one, they're a form of passive income. Everyone's dream. Imagine earning money whilst you sleep. But here's the real magic. Reinvest in dividends. This is called the snowball effect. Now let's fast forward to 2024 and see how this has changed. If you imagine the stock price of Coca-Cola increase by 6% per year over that 20 years, then the stock price would be $320, increasing from the $100 in 2004. And if we also imagine that the dividend yield increases 5% annually, that will give us $10.61 per year in dividends, increasing from the $4 in 2004. This would give us a total return of $106 per year. That's coming from the original $1,000 that we invested in 2004. So that's a 10% return per year for free. You haven't done anything but purchase $1,000 worth of stock and held it for a long period of time. This is where that snowball effect comes into play and allows you to retire at a good age. Now let's take this one step further. A lot of exchanges online, exchanges are what allow you to trade, have something called a DRIP. A DRIP is a dividend reinvestment plan. This allows investors to reinvest their dividends into the underlying stock. So, if we had that $1,000 worth of stock back in 2004 and we reinvested our dividends every year, this would mean that the dividends that we receive each year come to $216. instead of the 106 we mentioned earlier on. This will give us a 21% return every year on the $1,000 we invested 20 years ago, purely because we reinvested our dividends. And a lot of platforms actually do this automatically for you. It was Albert Einstein that said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." Now, if the smartest man in the world is saying something like that, I think it's probably fair you should take it into consideration and start investing in dividend-focused stocks. Now, I'm not saying you need to focus your entire portfolio on dividends, but having a small percentage of it focused in this area would help you grow your wealth significantly over the years. So, now let's get to the important part. How do you choose a good dividend stock? Let's take a look at the TradingView screener, which I've customized with filters that will allow us to find stocks that have good dividend payouts. Now, I've been using TradingView for many years now. They have an incredible platform. It's really fluid. The UX and the UI is beautiful. They have everything you possibly need to get stuck into trading and investing. And if you want to sign up, you can get $15 off your plan by following the link in the description that I put below. So sign up, get $15 off, and start investing with TradingView. So let's start. Let's start by going to products. You have your super charts where you can look at the stock prices and the charts of any stock you like. And then you have your screeners. So we're going to go to the stock screener. In here, you have different filters and different options to screen and find any stock you like on the market. Now, I've already put together a screener for us with selected filters. So if I go here, I've got S&P 500 dividends. Okay, so I'm going to focus on that one just to make it simpler for you. We're going to focus solely on the S&P 500. Going in here, you can see that I have added a few different filters that will help us find the correct dividend paying stocks. And I'm going to go through each of these in detail. Now, firstly, let's look at dividend safety. So when you're investing in dividends, you get something called a payout ratio. And this is a percentage of a company's profit paid as dividends. A ratio that's above 75% could mean trouble. So try to look for something between 10 and 50%. This is the payout ratio here. As you can see, Ben here, 143%, far too high. Stay away from it. EMR, I'd also probably stay away from that at 61%. If it's in an industry that's quite good, then possibly, or if they're looking to increase their revenue in the next 12 months, then it could be possible, but I try and avoid anything over the 50%. QCOM, fantastic. As you can see in the green here, I'm already invested in that. SYY, so Cisco Corporation, is 51%. If the rest of the fundamentals are good, I would look into that as well. Things like Costco are fantastic, 26%, okay? But once again, the growth isn't as great if you've got a lower payout ratio. Now, moving on from the payout ratio, we've then got the dividend yield. That's something we spoke about earlier on. So you can see the yield of each stock here as well, okay? We've then got the DPS growth, so that's the dividend growth. So try to find one that is growing consistently. QCOM is 6.45%, Costco is 13%. These are excellent figures, okay? Try not to find anything that's too high, because once again, that could be dangerous. You also want to look for companies that will constantly increase their dividends. These are called dividend kings. So companies like Johnson & Johnson or Procter & Gamble, they raise their dividends for over 50 consecutive years. So over here, you've got the continuous dividend growth. This is something that you can use to find out what companies in this list are continuously paying their dividends. So the dividend, say for example, if the dividends increase from $80 to $90 to $100 each year without any reductions, this would show 3 consecutive years under continuous dividend growth. So right here, say QCOM, the one that I'm invested in now, That has 19 years of continuous dividend growth. That's something you really need to invest in, because it means that potentially over the next 10 to 20 years, you know that each year they are going to increase their dividend value. Now let's look at the pros and cons of dividends. Firstly, dividends are a passive income. Dividends are a great way to earn money without selling your stock. Also, reinvestment. You can reinvest your dividends to buy more shares and watch your wealth grow even faster. Third of all, stability. Companies that pay regular dividends are often more stable and financially healthy. And less risky. Dividends can help cushion against stock price drops because you're still earning money from the dividends. Even if the stock price falls, it's still generating income. Now let's move on to the cons, because everything that has a good side to it also has a bad side. Yes, they are taxable. Dividends are usually taxable, meaning you might have to pay taxes on the money you receive depending on your country's tax rules. So always get an accountant involved or a financial expert that can look into this for you. But just remember, you will have to pay tax on anything and everything you sell online. If it's dividends, or if you're closing a stock, you do have to pay tax on that as well. Dividends are not always guaranteed. Companies can cut or eliminate their dividends if they are facing financial trouble. So dividends are not always reliable. So do make sure you do your research and check stocks that are paying consistent dividends every year. Slower growth is also something to look into. Companies that pay dividends might not grow as quickly as those that reinvest their profits into expanding the business. So now you've got some more information on how dividends work and how you can invest in them. Now let's do a little wrap up just to make sure you understand everything fully. Firstly, don't chase high yields. A stock paying a 10% yield might seem amazing, but it could be a huge red flag. So make sure you do your own due diligence and look into these in more detail. Stay patient. Dividend investing is a long game. It's not a get-rich-quick scheme. So hold in there, keep your stocks, and in the long term, they will benefit you. And diversify. Don't put all your money into one sector or one stock. Spread it out to reduce your risk. And reducing risk is one of the smartest things you can do when investing. Now that's it for today's video. If you found this interesting, please make sure you like and subscribe and hit the bell icon so you don't miss anything that I post in the near future. And let me know in the comments, what's your favorite dividend stock? I'd love to hear your thoughts. But until next time, take care.